Welcome to Startup Growth Stories by ARC. Hear from founders of bootstrapped startups and decacorns. We discuss the successes and the failures and the things they learned along the way. In the final minutes, founders get vulnerable. They share how growing their business has impacted their lives. Join us every Thursday for a new startup growth story. And now, here's our host, Don Muir.
Good morning. Today is a special day. I'm joined here with Simon Taylor. Simon's the head of strategy and content for Sardine.ai. Sardine enables all companies, whether big or small, to improve risk management by having the world's best API for fraud detection and compliance. Some of Sardine's most notable customers include the likes of FTX, Relay, MoonPay, and Brex. For those who don't know, Simon is one of the most influential people in banking, insurance, and fintech. He's a founder. He led blockchain research and development at Barclays, and he's the co-host of both Fintech Insider and Blockchain Insider. In most episodes, as you know, we explore the journey of starting and scaling a company. And while we'll certainly touch on some of that today, we'll spend the majority of our time together discussing macro trends in the banking and fintech space and dive into the weeds in the technology that's changing the fintech ecosystem. Thanks for coming on the podcast with me, Simon.
Thanks for having me. Excited to be here.
So the first question we ask all of our guests in 5 words or less, who is Simon Taylor?
Fintech nerd.
Love it. And what is Sardine?
The world's best fraud team you hire as an API.
Who is your biggest inspiration?
I don't think the question's who, but what next? Everything. I'm omni-curious. Like, it'll pop up in front of me and I'm going to love it. Content. Somebody builds something, writes something, does something, and I just find it exciting and I have no idea why. That's why I call myself a fintech nerd and a crypto nerd. Like, I find this stuff exciting, genuinely.
Any particular?
What are you doing when you're standing in line waiting to get on an airplane? Because I'm scrolling Twitter reading about fintech and crypto. Like, that's those little moments of boredom. You can tell what your true passion is. For a lot of people, it's sports or it's lifestyle or it's family or it's something else. Sorry to my wife and baby daughter, who I love dearly. The first thing I do is reach out to Twitter.
Any particular tweet today that caught your eye ahead of this podcast?
Yeah, there was one by Zero Hedge. I don't know if you follow the account or know those guys. They're a very opinionated, anonymous blog that talks about macro, and they covered the Bank of America results. And B of A was talking about their lending averages, FICO scores being in the almost 800 regions across all of their product range. But that's an anomaly. Like, it looks like they've done amazingly well, but have they? And was it a point in time? Was it pandemic related? So, just like one tweet can tell 1,000 stories once you dig beneath the surface. And that's kind of what I love.
Awesome. That's actually a really great segue. Normally at this point in the conversation on startup growth stories, we'd get right into the thick of it, understanding people's companies and talking about the founding story. But since this is a special episode and we're lucky to have you here on the call, we actually want to pick your brain on, for the first half of the conversation, the experience you have in fintech and better understand what the hell is going on in the macro. So we talk a lot about Fed rates and rate hikes and how that's impacting, cost of capital and the impact on startup valuations. I'm wondering if you can kind of share your perspective on what's going on with the macro economy as it relates to rising interest rates, as it relates to startup valuations and the broader fundraising environment inside and outside of fintech.
I guess it depends how far you want to zoom out.
It's a broad question.
1929, it's kind of sound money and the Bretton Woods and linking to the gold standard and Volcker and everything else. But let's not do that. Let's talk about the pandemic. So in 2020, we see the market craters, and fintech companies initially struggle for funding, and the whole market, the tech market, just has a quiet period and then inverted. The stimulus came, but that stimulus was sitting on top of 2 decades of all-time low interest rates, going back to Greenspan. And there was a lot of money flowing towards VCs because there was no other asset class that was delivering a return. Investors were searching for a yield. They had to go risk on to get that yield. Everything went to venture. So equity started to look like debt was something that the capital markets guys used to say, where it was just kind of low risk. It's going to give you a return. You might as well look there. But of course, this was a temporary 20 years of history that doesn't look like anything else apart from maybe the Weimar Republic in Germany. And so it's a really weird point in time. So there's all of these charts that you guys may have seen in the past 2-3 weeks about, oh my God, quarter over quarter, year over year funding has cratered. It's down 70%. But if you actually draw a line to where it was before the pandemic, it's about the same. We've reverted to the mean in terms of VC funding. And I don't know if you've seen, but VCs in the last 12, 18 months raised all-time high rounds, Andreessen and Sequoia, they've raised billions upon billions, and there's no way they can possibly deploy all of that at Series A. They're going to have to deploy some of it, and some of it is committed to deploy at Series A. So they're out of the market temporarily, but that's, I think, allowing time for prices to reset just enough to historic norms and to revert to the mean. Because let's face it, pre-seed 100x revenue, pre-seed, not pre-seed 100, seed 100, 1000x revenue, Series A 100x revenue, Series B 100x revenue, 150x. I figured out somewhere, or I did the napkin math on, you remember fast.com?
Yeah, of course.
Appeared quickly and disappeared just as quickly. Based on the revenue they had, the ARR they had, they were valued at 166x revenues. And there was no business, there was no long-term contract. Great at marketing. Amazing story for how you do get attention and build a almost consumer awareness brand. Like, there was a lot to like there. But maybe things did get a bit silly. And it's unfortunate now that founders and builders of today are feeling that. But really, we never had it so good for a while. And that's correcting. And it was bound to happen.
So I'm hearing a couple of different things there, and I want to double click. One, you're saying it seems like venture is raised a lot of capital and they're sitting on a lot of dry powder and they need somewhere to put that capital. And so to me, that would say that the market will come back. So one question for you is, when will the pain stop? When should founders think about their next round, and what should we expect looking into 2023?
That's a really good question. I think great businesses that are starting to show traction will never have a problem raising if they need to. But beware the terms and conditions, beware the liquidation preferences, beware all of that kind of stuff that gets thrown in, because even flat rounds aren't really flat anymore if you start really looking at how some of these term sheets are getting constructed. And reset your valuation expectations and reset your growth expectations and have conviction that you can grow top line revenue and start telling a revenue story. Everybody wanted to, in consumer, everybody wanted to talk a user growth story, a customer growth story. And that's not wrong, but it needs to be a revenue story. And I think there's kind of a barbell here. There's the public perception, or there's what everybody says out loud, which is, oh, it's about profitability. And then there's the opposite end, which is user growth, SoftBank, doesn't matter how much it costs, we'll just pour capital on it, doesn't work. What we're really talking about is revenue growth, and what we're really talking about is Rule of 40 growth. Rule of 40, as many of you will know, is when you add up profits and revenues, that should equal 40 as a growthage percent.
So 2020, 2021, the mantra was grow at all costs, show traction and user growth, hype PR, and big flashy rounds at large, lofty valuations that sometimes didn't necessarily translate to fundamentals of the business. What do you view as what's most important in 2022? It's Rule of 40, which to me is gross profit and gross profit and revenue growth taken hand in hand. How important is getting to default alive, cash flow positive, efficient operating expenses? How do you think about kind of the full top to bottom P&L? And then specifically for fintech, right, where fintechs have had some of the largest valuations, some of the lowest margins relative to their B2B SaaS peers. How should a fintech founder think about valuation and fundraising? What's most important going into that next raise in this environment?
Well, see, a fintech founder is not one thing. A fintech founder of what? An infrastructure company? A fintech founder of a consumer neobank? So of what? But if we avoid that sort of like rabbit hole for a second, there's a conversation about it's just good practice to not burn insanely quickly on the assumption that the next round is coming. and to be showing positive unit economic trajectory over time. Like, just do that anyway. And the best founders always did. Like the ones that were either their growth was so good that it was trending the right way, or they were getting so much traction that they could trend it the right way quite easily. So I don't think it's like just be wildly efficient, default alive. You're still going to want to grow because you're in venture after all. You've founded a venture business. Like, don't throw growth out, but it's revenue growth, not user growth, and it's growth you can afford. It's not growth that with terrible economics. And I'm focused on like the top line plus the economics of that new customer. What does that mean for your pricing? What does that mean for your cost of goods sold? What does that mean for your underlying provider base? What does that mean for the consolidation? Sure, I just used that API and I plugged it into that thing because it was easy. But actually, is that worth another look? Do I need to think about my operating model, my OD, my talent strategy? And, especially for businesses that have been through layoffs, how do I keep the culture going and pointing the right way and get people really energized and excited about running through walls with this thing that's kind of streamlined? So really hard to answer that in general. It's kind of like the question, how should I improve my health? And it's like, well, there's the good advice that works for everybody. And then it's like, there's you. So is that going to work for you? I don't know. Can you have diet discipline? Do you get up early? Like there's a bunch of stuff.
That's all incredibly insightful. So who's to blame here for what we experienced in 2021? A lot of the founders that I talk to feel like they've been retraded by the equity markets, right? In 2021, it was growth at all costs. It was building a big team. It was hiring the best, most expensive engineers in the Valley, building a huge amount of OpEx and burning through cash that investors gave them at a large valuation. Now they're getting in trouble looking into 2022 where they can't raise at those same prices and well beyond cash out date to grow into their multiple. So is it the Fed with the zero interest rate environment that drove up asset prices? Is it the venture capital investors who kind of chase these prices to the top? Or is it the founders themselves who are irresponsible, over-investing, overspending capital? Do you have an opinion there?
It's a curse on all of your houses, ultimately. Like a responsible serial entrepreneur who's built multiple businesses would go, this is weird. It's never been so easy to raise money. I don't like the valuation in these term sheets. They clearly don't care about my business, and I don't have any level of conviction I can hit profitability given what I've seen in the past. But somebody who's a lot younger wouldn't have that experience. Then, the Fed, sure, they've raised rates, but they didn't, and they used to cut rates, but they didn't print the money, the stimulus checks, and a lot of that was a government policy. So, and that was responding to a pandemic. So what? There's a virus that we're going to blame, and then that was responding to a global financial crisis, and that was responding to and all the way down. So ultimately, I can be angry. Old man yells at a cloud, or I can take some level of personal responsibility and learn the lessons. And I think that's always the key thing here is like nobody duped you, but they would have pushed things and they would have sold things based on realities that were true in the time. But that's always the case. And hopefully, people learn the lessons from this. And I really feel for anybody that's A, having been laid off, but B, my God, do you think being laid off it hurts? And my God, it does, and it has real consequences. Try laying people off and dealing with that on your conscience. Like that's insanely hard thing to do. So I have a mad respect for anybody that has to do that and has to go through that. But this is insanely character building, and it will make you stronger. And the businesses that get through this will be so much stronger. The lessons you learn will be stronger. And I hate to say this, but there were a lot of things getting funded that probably shouldn't have. There were a lot of things that were features, not products, and a lot of things were products, not businesses. And there were 16 things in the category that all looked the same, that all reached massive valuations. And that's not sustainable. Like the market always wins. And so the real question is, where does conviction come from when reality smacks you in the face? And macro, reality could yet get a lot worse.
That's incredibly insightful. And actually one of the reasons that we launched Startup Growth Stories in the first place, it's really to help founders weather the storm together, understand that we're going through similar problems, and then meet with experts like yourself who can actually, provide insight and perspective to help us get through these challenging times. One kind of tangentially related question I had for you. You've mentioned in the past how public markets have diverged from private markets. Is that still the case? What are you seeing in private markets? Have multiples finally kind of permeated down to, Series B and Series A startups?
It's I'd say no. There's still a difference between the two. Like public multiples for fintech now are anywhere between 1x and at a top end maybe 8x revenues if it's a real performer. Consumer fintech is somewhere between the 2 and 3x revenues. You're in that sort of ballpark, which is not a million miles off historic norms as well. That's a good ballpark, really. But then you consider, Walmart has a market cap where it's 460 billion, but it trades at zero point 0.6 times revenue. So your revenue multiple doesn't mean you are or aren't successful once you hit public markets, depending on how old you are. Some of those businesses that I mentioned, though, there's a really good piece by Morgan Stanley that I covered on Fintech Brain Food. Some of them are delivering Rule of 40 growth in the public markets, and those are the ones that are typically at the higher end of that. So that's, the market still likes growth on some level. It still helps you stand out versus your peers, versus things that might have, spacked into the public market and then, are really struggling for revenue and good unit economics. And it always comes back to the fundamentals. It always comes back to the fundamentals. On the private side, look, I have no history in VC. My desk is not crossed with thousands of deals per week, far from it. But the noises I'm hearing are, again, it looks and feels like 2019, 2020, which is not far from reverting to the mean. The interesting question is, does that go further, given, as you say, the VC dry powder, but given that macro is still trending negative for quite some time?
Yeah, makes a ton of sense, and time will tell. The question is, are we going to revert to the mean, or are we going to crash straight through it and need the pendulum to swing back up before we get there? So it'll be interesting to see.
For a hypothesis as well. Speaking of macro, this is one guy's opinion with a lower confidence. Like a lot of the things I've said are all just my opinion. But the confidence level on this next statement, I'm closer to 65% on, and so it's not 100% confident, but there is a real probability that in hiking rates so fast, something breaks. The Fed will end up probably breaking the bond markets. And when they do, they'll start easing, but won't call it easing. And the market will know what's up. And things should start to even out on the pricing scale a little bit. And then we'll see what the real mean is and what the market really thinks, rather than going completely risk off and staying away from anything that looks like risk. But, the correction so far has brought us back to the middle of the long-term range rather than towards the bottom of it. The pricing pressure could come down a little bit more yet. But we saw this happen in the UK. The UK wasn't raising rates particularly quickly, and they broke the gilts market and nearly sent a bunch of pension funds under in the process. Now, part of that is to do with structural issues in how the capital markets work and all of that kind of stuff. But those issues won't be fixed quickly, and the US has its own quirks and foibles in that sense. So there's a chance we get to see early next year that the mood music changes in pricing and markets, even as the real economy starts to feel the real pain, as inflation hits, as rentals hit, as all of the impact of these rate rises start to hit the real economy.
It's really interesting. And for credit-focused fintechs, where access to capital is existential, capital market strategy is obviously essential. And so in this capital markets environment, how should fintech startups who are credit focused think about their next move? Think about access to capital. Is it getting more expensive? Should they wait to raise their next warehouse facility? Should they consider, Topco financing? How are you kind of seeing the trends that you just mentioned in this environment impacting credit focused fintechs?
The balance sheet power matters, and the banks are back, my friend. Where it used to be sort of much more over the counter, much more go find those buyers, go find those specialists. The banks are really in the best place. I mean, they're extremely well capitalized. They have the relationships. They've been paying attention to fintech, but they didn't stand out and deploy, and they're the ones that can now deploy because they're in this different position. They are designed by their structure to be counter-cyclical, and that's kind of exactly what they're able to do. So as I speak to bankers in particular, they're licking their lips, and they're off to the races when it comes to that side. If you don't have the relationships there, then I would start thinking about who are those folks to start building them with, depending on how your desk is structured and what your sources of capital have been historically. But that's just a mood music piece. I don't have empirical data on that. Just I've spoken to 4 or 5 bankers who are sort of saying, look, we're getting a lot more attention. The aggression in pricing has kind of gone away a little bit more. The focus on underwriting has definitely appeared, and the risk committees that weren't letting them win deals before suddenly are the ones that have left them in good shape to be the ones that can write deals now.
And when you say bank, you're referring to the multi-$100 billion, publicly listed offline financial institutions that have dominated the landscape for the last couple hundred years. I'm curious. I'm curious if you have a point of view, and I know you do because I read your newsletter. But on the emergence of kind of this BaaS ecosystem and the emergence of digitally native, challenger banks, perhaps on the consumer side, but also I'm curious if you have a point of view on the business banking side as well. Where does that all fit in here?
Partner banks have done an amazing job in unlocking consumer and B2B fintech in an amazing way. They provided access when nobody else would. And if you look at some of the biggest fintech companies you can name, generally you can find a tiny a tiny partner bank underneath it that's sub 10 billion in assets. And that goes back to the Dodd-Frank Act of 2010 and something called the Durbin Amendment, which essentially said it was designed to reduce the fees, the swipe fees that merchants had to pay. So you walk into a store with your credit or debit card, well, with your debit card in particular, and small business gets hit with like a 2.5% fee for that transaction. And what the Durbin Amendment said is that's not okay for the big banks, but we'll leave it there for the small banks. And hopefully that means that the small banks get to survive and thrive, but that small businesses also win. The unintended consequence of that was that these small banks discovered that there was a new type of partnership they could do with these fintech companies. And because they could revenue share the swipe fees, there was so much more to go around than there would be if those organizations went to one of the bigger banks. So I'm Square or I'm Chime or I'm somebody like that, and I want to go do a debit card. If I go do that with one of these smaller partner banks, I can actually make a material amount of revenue out of that business model. And so that absolutely takes off. The problem was these tiny organizations were designed to serve a local community. They weren't designed to serve tens of millions of customers via somebody else. Now, a lot of the big sophisticated fintech companies have put in lots of operational controls and fraud controls and everything else. But these tiny banks are still quite small. And so the regulators are coming in and starting to really sort of say, hey, we're not so sure that all of you have got your act together. Of course, some have, but there's that regulatory pressure coming there. There was also a generation of intermediary infrastructure providers that popped up, the so-called banking as a service provider. And they all look a little bit different. And a lot of things that are actually very different businesses get lumped together. But if you're not familiar with fintech, businesses that might stand out are companies like Unit, like Synapse, like Bond, like Treasury Prime, and people will name Marqeta and Galileo, but they're actually a different thing. But that aside, all of those businesses get named, and they're a part of this mix where you take this really tiny bank, you take an infrastructure provider in the middle, you take a consumer brand at the top, and you have this entirely new distribution model for finance where you're using a debit card, you're using an app that feels a bit like your bank's app, but it's not really a bank. But we called these things neobanks, and regulators went, we're not so sure about that. What happens if something goes wrong? And then that becomes a whole rabbit hole of questions. So I don't think the partner banks as they exist today with the operating model they have will necessarily be the same. They're going to have a lot more competition from the big banks who now see the opportunity and are coming towards winning that sort of business. And they're also going to have a lot more regulatory scrutiny. Some will succeed, some will do extremely well, but not all will. And so that's going to be an interesting thing to see how it shakes out.
What is it that has unlocked this opportunity for these digital banks? Why has this product taken off? What's been the gap that they're serving in the market?
I think a couple of things. One was banks had quite a high bar, especially if you were time poor and low income. You had to go into a branch during 9 to 5 to open a bank account 10 years ago. It's no longer the case now, but it was for quite a lot of banks 10 years ago. They also couldn't do basic things like move money in real time. And then Cash App comes along and says, well, if you want to just send that money right now, you need to pay somebody or you need to get paid. Push a button, it'll cost you $2 and you'll get that money right now. Same with Chime. They introduced the get paid 2 days early. All of these little things that nobody in the banking industry had bothered to do, but was entirely possible to do, becomes these killer features, these standout reasons why you need to use that app. And yes, it was a better experience, but it was also financial innovation. It was product innovation that kind of made the difference. And then those apps expanded from there. So there was one, solving a consumer pain point, but two, there was a revenue model baked in, which is the Durbin Amendment and the revenue share, which is if I'm growing users and I'm getting revenue through the door, my unit economics may not be great, but I could expand that and I could launch other products. I have a way to get to market. I'm solving a consumer problem. What's happened in the years since is a lot of the banks have copy pasted a lot of those features. But now the consumer, instead of having their primary bank, they have 5 or 6 fintech apps where they might have Robinhood and they've got Cash App and they've got Venmo and then they also sometimes use Zelle and then da-da-da-da. So this is a much more complex world the consumer finds themselves in.
Yeah, it's really insightful. Do you view consolidation, these super apps or apps that have multiple features that solve multiple customer pain points as a trend you're seeing in the market?
Yeah, I mean, it's the circle of life, right? As companies reach a level of maturity, their growth has to come from somewhere. Some will be specialists and stay niche, and that limits their long-term top-line growth. But Cash App is becoming a different monster over time. PayPal can do just about anything. Venmo's going wider. And so I do think that's somewhat inevitable as these things start to chase revenue and reach a certain maturity. The interesting question to me is how many start to look to get charters and get into lending. Some will stay away from it, but getting a full banking charter is hard and expensive and slow. And getting the charter is hard, keeping it is harder. Just look at Varo right now. Like it's 2 million plus users. It's an organization that has got its charter, but it's going through the growing pains of putting in all the structures it needs to get efficient and to be able to lend as a bank now, not as what it was, which was a neobank. And you've seen this elsewhere. We saw it in the UK with the likes of Monzo, who went through something similar.
Right.
They were a neobank that became a bank, had about 2 years where they just paused product development more or less just to fix all of the stuff they had to do to be a bank. And now they're slowly starting to get into lending and deploying lending and so on. But it's not their natural skill set. Their great skill set is being a great UX, UI, and everyday spend card. Can they get into lending and do they have that DNA? So you've got these things that used to be neobanks that become banks, which is one route to go. And then you have the other one, which is things that don't ever want to be a bank, but actually rebundle things. The Fintech super app, as you call it. Probably the closest, again, is your PayPals and your Cash Apps in there, although Cash App has an industrial loan charter. The other one would be Revolut in Europe. They do everything from stock trading to crypto to you name it. They've got a thing that does it, and underneath the hood, it's like 1,000 different partnerships. And maybe one day even the Apple Card kind of heads that way. Like they're sort of becoming this. Underneath the hood, it's 15 different providers, but to you, it looks like one, rather than they're doing all the manufacturing. That's the fintech super app thesis, and that's kind of interesting. But it relies, again, regulators raise an eyebrow at that approach. So it's gonna be interesting to watch what plays out in the next couple of years.
Thanks for sharing all these insights. There's so many takeaways here. In the last segment, I want to switch gears just a little bit. Our listeners are the founders, operators at seed, bootstrap through Series C, SaaS and fintech startups. We know that building a fintech company is very complex. By comparison, the regulatory considerations, access to credit, maybe SaaS sounds a little bit less intimidating. I'm curious if there's any advice you have for first-time fintech founders and whether that is different for first-time SaaS founders as they navigate this evolving macro environment.
I think my TLDR on fintech is payments are easy, edge cases are hard, and payments are absolutely full of edge cases. And so you need to understand those critically or hire somebody who does. Secondly, lending is easy, getting paid back is hard. And thirdly, everything is compliance. And so if you figure that out, it's almost backwards. Now, you don't have to be an expert in any of those. In fact, you probably shouldn't be, but you should know it and you should get into the weeds and you should grok it and you should get into the detail of it. And that's just going to be an absolute superpower. And I think there's a lot of folks and operators out there now that understand this stuff. And there's a lot of folks who either just let go or they have, options in a startup where the valuation's underwater. There's a lot of talent out there that might be looking for the next thing. And there's a lot of VC dry powder out there. Like your timing could be really good if you understand the macro, you understand where the market's going, and you are humble enough to say, okay, I don't know everything, but I'm going to try like my hardest to learn it. But also, if you have the conviction in your idea and you can keep pushing, because there's a lot of things that TradFi and traditional financial services will tell you can't be done and absolutely can be done. You just got to find it. I come back to Chime, they get paid 2 days early. It could always be done. A lot of people in financial services would say, oh, but it's too risky. Is it though? Or is it now a killer feature and it's become the norm and everybody's adding it? So that would be kind of the balance I'd hope to try and bring.
You've come a long way in your journey. You've accomplished a lot. For those of us who are earlier in our careers, can you share one pivotal moment in your life or in your career, in your entrepreneurial journey that changed your ultimate trajectory?
I left school at 16. I worked for a telco for 8 years as a software engineer, and I was just kind of coasting along. 8 years is a long time. And it was actually getting testicular cancer where I was forced to really stand back and evaluate, what I want from life and what I wanted to go do. And I was just such a big fan of technology. I knew I had to get closer to it. And I'd done software engineering, but I wasn't good at it. And that's when I started down the journey of trying to found a couple of businesses and kind of moved on from there. Eventually had to get a job. And the company I got a job for, this is how long ago it is. I'd be scrolling on my BlackBerry reading TechCrunch, and I saw something about the founder of Twitter, Jack Dorsey, steps down to build a nutty new startup called Squirrel. Now, it did not end up being called Squirrel. It ended up being called Square. But I emailed that to the leadership of the company I worked at. And instead of, telling me off, they created a job for me as the head of innovation. And the rest sort of took off from there. So I think follow your instinct, follow your gut. And sometimes the setbacks can be the most important things for you.
Incredible. Simon, we'll call it there. Thank you so much for joining us today. Really insightful conversation. We're excited to share this story with all of our listeners in the world. Appreciate you joining Startup Growth Stories and looking forward to staying in touch.
Thanks for having me.
Thanks for joining us for another episode of Startup Growth Stories. To continue the discussion, head over to arc.tech.